Hi everyone. So welcome to the stream today. Really excited for having you on the stream, and this is a special discussion we want to have because the Bank of Ghana is in almost the final stages of putting together a framework for non-interest banking here in Ghana. What does that mean? It means that Ghana is from 2026, hopefully, or something like that, is going to enter into non-interest banking, which means that we are going to be employing Islamic financing. So on the masterclass discussion today, we want to go through a number of things. Number one, what is Islamic finance, non-interest banking about? Number two, we're going to be discussing the various principles underlining this banking system. Number three, we're going to look at some of the issues in respect of the various instruments available that can be used under Islamic financing. And then the fourth thing will be, as accountants, financial, how do we represent this in accordance with the IFRSs in the financial statement? These are important issues because having the understanding of these will position us to be able to really apply and understand what this key change is about. Now, you must also understand that we are, give me a sec. Okay. So you must also understand that we are going to also be, I'm going to be answering questions. So if there are any questions you have, something you want clarity on, you can put it in the comment section or the chat, and I'm going to be providing you with all the answers that you need. Remember also that our registration is currently ongoing for the March 2026 examination. So if you are looking at registering to start studying ahead of the March 2026 ICAG examination, you can send us a message on WhatsApp or visit our website NhyiraPremium.com, and then you'll be assisted to be able to complete your registration so you can start studying for the examination. So let's get straight up into the discussion. What is Islamic finance? What are the principles underlying Islamic finance? Why is the Bank of Ghana going into this arena this time around? What are the things we are supposed to know, and various things that we need to be getting excited about? So let me bring up my screen quickly and let's go into the discussion. So Islamic finance. Let's start basically with some background, some understanding, and various things, some key principles here. Now, the Islamic finance system is simply a system where banks, financial intermediaries, will provide finances, but using what we call the Sharia or the Islamic law. And the whole thing is to promote ethical investing, fairness, and social welfare, fundamentally different from the conventional financing. So the goal here is, how do we promote ethical investment? How do we bring in some fairness? Because we're going to be talking about the differences between the traditional or conventional financing, like you are looking for money, you go to the bank for a loan, what the bank does, and then under the Islamic financing, how it's supposed to be done. We're going to be talking about that basically. But the idea is that currently, if you are looking for money and you want a loan, what do? You go to the bank. And the bank is going to ask for audited financial statements, collateral facilities, and all that, and the bank gives you the money. Now, irrespective of what happens, at the end of the day, the bank is going to be requiring you to pay X amount of interest, sometimes very significant amount of interest, and they will demand, whether you lose or you gain, to pay the money back. And so it makes traditional financing or conventional financing quite challenging, unattractive, and it is not all businesses that will leverage it or that will be able to use it. But Islamic finance is coming in to bridge the gap. Now, if you're somebody who is doing financial management, this is a fundamental area, because in financial management, that is ICAG financial management or ACCA financial management, when you talk about sources of finance to an organization, Islamic finance is there. If you are doing strategic case study also, you must understand this. So in addition to having the understanding of these things and how they apply to in the preparation of financial statements for corporate reporting students, financial reporting students, the IFRS part, financial management students, and strategic case study, these are also going to be valuable things that you must understand. So let's begin the journey with the core principles. Number one is the prohibition of interest, which is Riba. In the conventional or traditional finance environment, the bank gives you money and charge interest on it. But in Islamic finance, interest is forbidden. And so that is the idea here. So charging or receiving any predetermined or guaranteed interest on loan is forbidden. That's the thing. Okay, so if interest is forbidden and I give you money under Islamic finance, how do I get my money back? Simple. Profit must be generated from real economic activity. And that could be trade, it could be investment or service, but not just lending money. So the rule about Islamic finance is that, or the Sharia law is that, hey, I cannot just sit down doing nothing. Then I say, oh, I have money. Then I said, okay, let me give that money to you, Titi. Then you take that money and I sit down. I don't do anything. Then you go use the money to work. Then you give me interest. That is the traditional banking. But in the Islamic finance environment, that ideology is forbidden. Riba is prohibited in Islamic financing. 2, prohibition of excessive uncertainty, Gara. Transactions involving excessive ambiguity, uncertainty, or contractual vagueness are forbidden. This rules out conventional derivatives and what? Short selling. So anything that involves a lot of uncertainty, Islamic financing say, hey, listen, let's not get into it. Because in the traditional financing, you can still get the money and use various derivative instruments to try to hedge against it so that the worst of the worst outcome does not happen. And if sometimes the stakes are very high, but people will still go for it. In Islamic financing, we want to be as reasonable as possible. Yes, there could be some uncertainty, but it shouldn't be excessive. That's the second principle we must understand when we talk about Islamic financing. The third one is prohibition of gambling. May say, earning money purely from chance or speculation activity is forbidden in Islamic financing. And this is in the Islamic law, right? It's in Islam that you are forbidden from engaging in any speculative gambling activities. So if you remember earlier this year also, the president, I think the President of the Republic, John Dramani Mahama, appointed Mr. Mohammed Abdul Salam, who is a Muslim, to head the National Lottery Authority. And you saw the backlash. If you follow the news, people were like, oh, you are a Muslim. This is forbidden in our religion. You cannot go and head National Lottery Authority because this is speculative. This is forbidden. This is may say. You cannot do this. But the guy was like, hey, I've been appointed. I'm going to execute my mandate, right? Then there was a time also, there was one gentleman who won a bet who happened to be a Muslim. And so people were then questioning, but we thought in Muslim, you are not supposed to be gambling. You are not supposed to be involved in any of these things. How are you involved in these to the extent that you have even won significant amount of money? So that is the third principle in Islam, in the Sharia law, prohibition of gambling or speculation. What does that mean? It means you cannot go enter any Islamic finance transaction and go and use it for gambling or speculative activities. It's not possible. It's against the law. It's forbidden. Now, so what does this mean in principle? Does it mean that if the Islamic finance is brought in Ghana, let's say these betting companies, maybe they want to buy some new equipment, monitors and those things that they use at their center, or TVs or something, or maybe they are going to rent a place. Can't they use the Islamic finance available? I think they could, because I don't think we're going to be going strict with the laws or with the principles. Okay, there may be some overlaps at the end of the day because we are not, or Ghana is not a Muslim-dominated country like Saudi Arabia, Qatar, United Arab Emirates, and co. Because that is where you will see these things or these laws really being forbidden, and people or businesses abide by them. So I think the law will be a little, or the framework will be a little flexible here in Ghana, and all businesses, as far as it's a tool that is available, they may be able to engage in it. Then the last one is, or the next principle is ethical investment. Ethical investment. So investing in businesses dealing with prohibited, or investment in businesses dealing with prohibited or haram activity. So you want to do only ethical investments. In other words, you cannot engage, like we said earlier, alcohol, pork, gambling, pornography. All of these things are haram in Islam, because it is regarded as unethical behavior. So you cannot be like Pornhub, or you cannot be like an alcoholic company, right? Like maybe Casapreco, and they are doing expansion into the Alombo line of businesses, and then they will engage in use the Islamic finance idea. That's the idea here. Why? Because those things are regarded as the highest form of sin, so they are not ethical, and so they are prohibited. So ethical investment alone, we don't want any unethical thing. Risk sharing. One principle in Islamic financing is that, hey, the risks associated with whatever we are doing, because remember, the core thing here is we are undertaking an economic activity. So the risks will be shared. If there is any loss, both the provider of the finance and the partner who executed the job will share the risk. It depends on the way the risks will be shared. But unlike traditional banking, where you go take money from the bank to do business, and the business takes a nosedive, you lose everything, the bank doesn't care, because the bank will still demand you repay the loan plus the interest. That is the traditional financing. But under Islamic financing, we're going to be sharing the risk. So if the business goes south, the bank is also going to be bearing some risk, not only the entity executing the contract, that will be bearing the entire risk. Then the last principle is asset backing. This is a real asset transaction. What does that mean? It means all financial transactions must be tied to tangible assets or legitimate trade or service activities. In other words, money is treated as a medium of exchange, not a commodity to be sold for profit. Again, in traditional banking, what do we see? You need a loan, you go to the bank, and the bank says, hey, I'm giving you X amount of money. So the bank is trading the money for profit. In Islam, under the Islamic finance, in the Sharia law, you can't trade money for profit, because money is a medium of exchange, not a commodity you can sell. So in Islamic financing, all the transactions, everything will be tied to an asset. So it is the profit from that asset, it is the income from that asset that the parties, both the provider of the finance and the one executing the contract, will benefit from. That is the idea about Islamic finance. And these are the core principles we must understand when we talk about Islamic financing. Number one, interest is forbidden, riba. You cannot charge interest. Number two, prohibition of excessive uncertainty, gara, forbidden. Three, prohibition of gambling and speculative activities, not allowable, mesa. Ethical investment, we only going to be investing in things that are socially or economically beneficial. Socially or economically beneficial, because alcohol is not socially and ethically beneficial. Pornography is not socially or ethically beneficial. And then other form of investments, pork, and those things not socially and ethically beneficial. Then the principle of risk sharing and the principle of asset backing. So these are the core principles we must understand when we talk about Islamic financing. Okay. Now, I have given you some of the differences between Islamic financing and then the traditional or conventional financing. But let's dive deeper a little and talk about some of them basically here. So what are the key differences? If Bank of Ghana finishes with this framework by the end of this year, hopefully, and maybe next year they start this, what is going to be the difference between conventional financing? I need money to buy a delivery van for my company. I go to the bank and I want a loan, or I undertake a financial instrument involving Islamic finance. What is the difference? Number one is the basis of profit. In the conventional financing, the bank make profit by lending the money to you and charging interest on it. So in conventional financing, there is interest, Riba, on the loans or the debt that the company gives to you. But in Islamic financing, as we said, it's about profit sharing, trading, leasing, relating to a real asset. So the basis of profit is not about interest, but the basis of profit is about sharing the profit, trading, or leasing fees which are related to specific assets. And we'll get deeper into this in a moment as we proceed. Number two is the relationship. In the conventional finance environment, the relationship is about a credit and debtor relationship, or a creditor and debtor relationship. Why? The bank is going to see you as a debtor because you owe the bank, and you're going to see the bank as a creditor because you owe the bank. So it's a creditor-debtor relationship. But when we come to Islamic financing, it's not about creditor or debtor relationship. It can be either partner-partner relationship, seller-buyer relationship, lessor or lessee relationship. And it will all depend on the type of Islamic finance instrument that you opt for. And we're going to see the types of models available under the Islamic finance tools in a moment. But that is the second thing. It could be partner-partner, seller-buyer, or lessee versus lessor. 3, risk. Under conventional finance, the risk is transferred entirely to the borrower. Like I said earlier, if you go to the bank, borrow money, and use the money to buy things, and something happens, maybe a flood, fire, destroys everything, the bank doesn't care. The bank will still demand you pay them the money they've lent to you plus the interest. So the bank is still going to be taking their money. So when it comes to risks in conventional finance, it is entirely borne by the borrower. But that is not what Islamic finance is going to bring. Under Islamic finance, as we mentioned, risk is shared between the parties. And we'll come back to this as well in a moment. The risk will usually be shared between the parties. So it is no longer you, the borrower, who will bear all the risks associated with the project. Partly, the provider of the finance may be bearing the risk, or some of the risks. Then 4 rather, focus. Under conventional banking or conventional financing, maximizing profit through monetary transaction. So that's their focus. So the bank is there to take depositors' fund and part of their own capital and give it out as a loan, and what they make from is through that money transaction. That's their focus. But in Islamic financing, as we said, profitability linked to real economic activity, which is ethics and gives social benefit. That is the fourth thing we must understand. So in Islamic financing, it's not about, hey, how do we maximize our profit on the loans we give? No, it's about, okay, how do we make profit from the real activities that we have undertaken? That is the idea about focus. Then the key instruments. Under conventional banking, there is nothing like, it's either you are taking a loan or it's a bond. And the interest rate could be fixed or variable. Asa? So you go to the bank, you said, I want a loan. Okay. It's either they will set a fixed interest rate for you over the term of the loan, or it will be a variable interest rate, which means that it could be pegged against the policy rate of the central bank or pegged against the inflation rate of the country. So in that case, you are going to be having a variable interest rate. But under Islamic financing, there are various instruments available, and you would decide which one you want to go for based on what you want to buy. So we will get into these in a moment, but we have Murabaha, Ijara, Musharaka, Mudaraba, and then Sukuk or Sukuk, depending on the school you attended and the one who taught you how to pronounce things. But these are the differences, if you want, that we can talk about in respect of the conventional banking and then the Islamic finance. So if you pay attention closely, you will then realize that it will be beneficial to use Islamic financing than the conventional finance. Yeah, it is. And so somebody would then ask, why did it take Ghana a long time before, we could introduce this? Yeah, because, it is something that is developing. As I mentioned earlier, this is really dominated in the Islamic regions, right? The United Arab Emirates, the Qatars, the Saudi Arabias. Yeah, this is where, because it's their religion, right? So it's there. Now, sometimes the Islamic finance is also called Abrahamic finance, right? But really, it is dipping in the Islamic religion. So they are using it. So, but then now it is transitioning a little bit, coming into Europe, and Nigeria uses it, right? Because, to some extent, Nigeria is also predominantly having a lot of Muslims there. So the Nigeria government even has used some of these two, especially Sukuk, to finance a lot of infrastructure projects. And so now Ghana is at that point that we are transitioning into bringing Islamic finance, and it is going to help a lot businesses as well as even the government, especially using the Sukuk instrument, and we'll get into this in a moment, to raise finance for its capital projects that it wants to undertake, because there are a lot of capital projects that this government wants to undertake. So from a central government perspective, government is going to be using some of these tools itself. Then on business perspective, because of these differences between risk allocation, profit, the focus, the nature of the contract, many businesses would want to be interested in Islamic finance rather than the conventional finance. So these are the differences we must understand when we talk about the conventional finance and Islamic finance. So the big question we then have to ask ourselves is, all right, what are the options available then? So Bank of Ghana wrapping up on the framework to bring in Islamic finance. What are some of the tools? What are some of the options available? Yeah, we've mentioned some of them, but let's get deeper into them and see how businesses can use them. So let's look at a major Islamic finance instrument. Now, for the purpose of my discussion, we're going to be dividing this into maybe two categories. In some other write-ups or journals, they are divided into three categories, whilst in other schools of thought, it has no categorization. But I'm going to divide this into two categories for the purpose of my presentation tonight. The first category is what is called a trade-based category, which is where we are going to be talking about markup and sales contracts. And then the second category is the equity base, which is profit or loss sharing contracts. So let's look at the first category, trade-based instruments. Under these, we have the first one, Murabaha. Yes, that is the term, Murabaha. But the idea there is simply cost plus sales. So what is the idea here? Simple. A financial institution will purchase a specific asset. It could be a car, it could be an equipment, requested by the client from a third party seller. Then the financial institution would then sell the asset to the client for the original cost plus an agreed profit margin paid in deferred installment. The price is fixed from the start. So that is Murabaha. So what does that mean? Simple. we want money to buy a new delivery van. There are two options available. Per this introduction from next year, there are two options available. Option number one is to go to the bank and say, hey, bank, give me some loan. So just an example, okay? So let's say I go to First Atlantic Bank. I say, hey, First Atlantic Bank, give me a loan. We want a loan of 250,000 Ghana cedi to buy a new delivery van to deliver our products. Then the First Atlantic Bank will say, hey, listen, bring in the various things, a business plan, collateral facility, various things, bring it. And then they will say, okay, we will give you the $250,000 or Ghana cedi at an interest rate of whatever, let's say 35% over a 5-year period. And I take this loan. No matter what happens to my business, I am under obligation to pay First Atlantic Bank the full $250,000 plus the interest over the 5 years. I'm supposed to pay that money. That is the traditional financing. But with the introduction of the Islamic finance, if First Atlantic Bank opts to be one of the financial intermediaries to arrange this deal, I could still go to First Atlantic Bank, and instead of them giving me the $250,000 directly plus interest for me to pay over 5 years, they would rather go and buy the vehicle directly. It could be from Zonda Ghana or Kantanka Automobile, Toyota Ghana, or whatever. So First Atlantic Bank goes and buy the vehicle for me directly. Then they will sell it to me at a profit. So the vehicle will be given to me, then they will put a markup on it. And that markup will be whatever, 25% or 30%. That is the idea about Murabaha. So if you are paying attention well, somebody would then say, when they buy the asset and sell it to me, aren't they getting profit? Yes. If they give me the money and charge interest, aren't they getting profit? No. Because in the first example, the traditional one, they are selling money to me and they are charging me interest on the money. But in the Islamic finance under the Sharia law, money is a medium of exchange, not a commodity to be sold. Do you get the idea? So under Islamic finance, you are not supposed to sell me money and charge me interest to make profit. So now we will do Murabaha. So in Murabaha, the bank is getting a markup of maybe 25% or 30% on the 250,000, and it is tied to the delivery van that they bought for us. That is the idea about Murabaha. Cost plus sale. That's the idea here. That's the idea. Number 2 instrument is Ijara. This is like leasing. Ijara, leasing. So how does this work? You know leases already, right? That, okay, if we want a property, instead of going to buy it outrightly, we could lease it, right, from a lessor. The idea here is that it will still be arranged like that. But look at it. A contract where the financial institution purchases an asset and leases it to a client for a fixed period for a specified rental fee. The ownership will remain with the financial institution, which is the lessor, and the rent is a fixed service charge, not interest. In some cases, as you know already under leases, there may be transfer of ownership at the end of the lease term. So that is there. And that is the second idea here under the instrument available, Ijara, leases. I think on a space, 3 days today, Mr. Joe Jackson, the CEO of Dalex Finance, used this example and mentioned that they were looking for a property in Nigeria, and they went directly to lease the property, but it was expensive. But through the Ijara, there was an institution who leased the property and sublet it to them. Although they have to pay a higher price to the financial house arranging the Ijara, that one was on a periodic basis, unlike the original lessor who was demanding like 2 years direct payment at a go. So that is the concept of Nhyira. So whilst under original leases, the lessor may say, okay, pay me this money, you are locked in for 2 years or whatever number of years. In Nhyira, the entity, the financial institution, has the asset, leased it to us, and then we pay a specific fixed amount of money over a period of time at the end of the day. And as I mentioned, ownership may be transferred or may not be transferred. So that is the second type of instrument. Murabaha, cost plus. The financial institution buys the asset, then they will sell it to us at a markup. Nhyira, the financial institution buy the asset or has the asset, then they will lease it to us. They still own the asset. They are the lessors at the end of the day. But in some cases, there may be transfer of ownership. And if there is going to be transfer of ownership, that is where we're going to be having what is called Nhyira Muntahia Bil Tamlik. Forgive me about, these are Arabic, so forgive me if I don't pronounce it well. Don't take it personal in that case. So that will be a variant of Nhyira if ownership will transfer at the end of the lease term. That is what you must understand when we talk about this. Number 3, salam. Salam. Salam is like a forward sales. Salam. So what is this about? It is where the finance house prepaid for a commodity to be delivered at a specified date in the future. This is typically used to finance working capital of farmers or producers. So this is what is happening. A farmer has started. Maybe the crop season has started, right? And the farmer is looking for some combined harvesters to buy or some equipment to buy. The farmer now, currently, what is available in Ghana, has to go to the bank for a loan, isn't it? So the farmer will go to the bank. The bank will say, hey, farmer, bring me collateral, bring me your business proposal, bring me this, give me this. The farmer may not even get a loan at the end of the day. That is what is currently there. Then the farmer will be charged an exorbitant amount of interest. Now, this is what's going to happen. Whether the crop turns out right or not, the farmer is going to bear the risk at the end of the day. So that is the conventional thing. But under Islamic finance, using this forward sale agreement, this is what is going to happen. The finance house is going to advance the amount that they would have bought the goods at to the customer. To the farmer. So that at the end of the period, what is going to be happening is that when the farmer harvests, the farmer will sell that to the finance house or the intermediary firm at a predetermined price. Now, this is what's happening. The intermediary firm or the finance house would also have arranged a forward sale with other people who, when they get the goods from the farmer, they will sell to, so they can make profit at the end of the day. So it's more or less like the farmer gets money in advance, which they don't have to pay interest on. The only thing is that the price at which they will sell their harvest will be predetermined. So sometimes it could be lower than the original price they would have sold at. But it's okay for them because they've had the money ahead of time. That's good for the farmers. Then the finance house or the intermediary firm is also going to sell the harvested goods from the farmer to another company that they have, or other people, customers that they have had that arrangement with at a more higher price than they had bought it from the farmer. That is the concept of salam. So again, somebody will ask, does it mean that under Islamic finance, the banks are going to be tending into a trading company? That's not basically what is happening. Everything that is happening is just an arrangement. It's just an arrangement at the end of the day. So for instance, let's say that we are dealing with, a company that produces beverages, right? And they use oranges to produce the beverage. Okay? So you are a farmer. You need some money, right? So you go to the bank. Again, let's say First Atlantic Bank. you need some money. So let's say, just an example, let's say First Atlantic Bank is part of the intermediary firms to arrange this deal. We go to First Atlantic Bank. First Atlantic Bank is going to give us the money we need for the contracts, for the harvest we're going to sell. Then First Atlantic Bank will have a contract with one of the companies who use orange to produce their beverages, and tell them that, hey, listen, in 3 months' time, or in 6 months' time, or whatever time, I'm going to give you this quantity of oranges that you can buy, but you also buy it at this price. So what is going to happen then is that the farmer is going to be happy, because the farmer doesn't have to go and look for buyers. Because recently you heard about the local rice sellers association also on demonstration that they have surplus or excess harvest that nobody is buying. Now, when something like salam is there and is entered into, what it means is that the farmer will get their money, and the finance or intermediary firm has arranged with a company that is going to buy those produce already. So if this deal goes through, the farmer is going to be happy. No need to worry about who am I going to sell my things to. The customers are also going to be happy because they get the finished product to further use for whatever they want to use it for. That is the concept of salam. So really, this tool will, if integrated well, now it's not going to just be perfect when it is introduced. It's going to take some time. But after a number of years, it is going to solve a lot of problems, especially post-harvest challenges that farmers face when they cultivate their products. And so salam is one of the key tools that will help farmers. So again, you saw the news about tomatoes, right? There were times some tomatoes, tomato farmers harvested and they couldn't get anybody to buy. And so the president has to intervene, direct that the tomatoes should be bought and given to free SHS or something like that. With salam, if this deal is arranged, okay, the farmer has already will have a contract with the intermediary firm, and they have taken the money ahead of time. So no need for the farmer to now be crying again. Hey, Kojo Mahama, hey, we have harvested our tomatoes, oh, it is rotten, oh, nobody is buying, oh. No, because those tomatoes may be needed by a tomatoes, processing company into paste here in Ghana or even outside of Ghana. So now the financial institution or the intermediary firm is going to get those customers to sell the finished products to them. What a nice way to solve a lot of problems in this country. That is why this initiative, which is embedded in the Act 930, which is empowering the Bank of Ghana to introduce this non-interest financing, is going to be crucial and will really solve a lot of the problems that we have. So that is salam, forward sales. Next one is going to be istina. Okay? Istina. Or Istina. Istina. So just a quick recap. Everything we are doing here is about markup or leasing, right? So Murabaha, cost plus selling. Ijara, leasing agreement. Salam, what we just spoke about, forward sales. Then Istina is for manufacturing or construction finance. What does that mean? A contract to purchase a manufactured goods or constructed asset, example, a building, according to an agreed upon specification and a fixed price. Payments can be made in installments, and the item does not exist at the time of the contract. That is the idea about istinas. So again, a real estate company is, they have acquired some land and they have the architectural drawing and everything, and they want to build. Okay. Instead of going to the bank to take traditional loan and they will charge them interest, if any of the intermediary firms will be offering istina, what would they do? They will arrange that. And so, yes, we will take the money and we are using the money to build this particular houses at the end of the day. And when we start selling the houses, you get back your money because you are now a partner, okay, in the deal, and we pay you back plus whatever profit that is going to be coming on the deal. So this is also going to be good. This is also going to be good because asset financing, manufacturing financing is also one of the crucial areas. Aside the salam, this is also going to be a game-changing instrument, subject to the fact that the Bank of Ghana will be including that in their instruments that they are going to be introducing. As I said, yes, all these instruments are available, but that doesn't mean the Bank of Ghana will fully bring all of them. For testing the waters, they may bring maybe just 2 or 3 to see how it goes. Then as time goes on, they may be developing the others. Because the intermediary firms or the banks, this is a new world to them, banks in Ghana, right? And so they must look at it and see, will this give them more profit than the traditional giving loan and charging interest on it or not? So it's going to take time for some of these things to be fully implemented, but that is the idea about that. So just an example here about Murabaha that I said, like home financing here. So the conventional thing is that if you want to buy a house, right? So we spoke about Murabaha earlier, the cost plus pricing. You want to buy a house, what do? You take a mortgage, a loan for say $300,000 to buy a house. And you're going to pay that $300,000 plus variable interest for 25 years. I think recently Donald Trump is floating the idea of 50 years mortgage in America, right? 50 years mortgage. That's like you are paying the house over, your entire life, literally. But that is going to reduce the monthly payment and by extension the annual payment, and it will make affording or having your house cheaper. But that is the conventional idea. You want a house, okay, go and take a mortgage. They are going to be charging you and you're going to pay interest over a long period of time. In Murabaha, this is what will happen. A client will identify the house, which is $300,000. The Islamic bank buys the house and immediately sells it to the client at a total deferred price of, say, $450,000. Do you get the idea? And this will be paid on a monthly basis over 25 years. The bank's profits from the sale of the tangible assets and not interest on the loan. You see the concept here? So in the first conventional example, again, the bank is selling money, right? But in the Murabaha idea, what is happening here is that the bank is what? Buying the asset and they sell that to you for you to pay it over a period of time. So they are making profit from the sale of the asset, not interest on the money that they have sold to you. That is the idea about Murabaha. So what does that mean then? It means that, again, mortgage will be different. Probably it could make mortgage a bit cheaper at the end of the day, because if we are going to have a fixed payment, because one of the things about traditional mortgage is the variable interest issues, right? And the fact that sometimes the interest rate is going to be very high because of your risk as the customer. So mortgages are always expensive. But Murabaha is going to be bringing the cost of financing or acquiring home a bit lower, because here the bank buys the property, sells it to you, and that's all. It's an agreed price, and you have to make a fixed payment over a number of years, and that's all. Because the bank is going to, like we said here, the house is $300,000. The bank sells it to you for $450,000. It's done. Case closed. And so you are paying fixed amount of money, and there's not going to be any gimmick anywhere. So Murabaha, if introduced and well executed, and there are financial intermediaries, it could make owning home a bit cheaper. Just a bit cheaper. But that is the first category that we must understand when we talk about the Islamic financial instrument. These are trade-based instruments. Trade-based instrument. Any questions you have, please put them in the comment section for me or the chat box. So if there are any questions you have, please put them in the comment section or the chat box. I will really be excited to answer your questions for you and help you to address any concerns that you may be having at the end of the day. Let's see, give me a sec if I have something here. My hallelujah belongs to you. Okay. Let's look at the next category, which is equity-based instruments. So the first one, we looked at the issue in respect of the asset-based, right? Making markup or margin in that regard, trade-based issue. Now let's look at the equity-based. These embody the core principle of shared risk and consider the purest form of Islamic finance. Let's look at the instruments available here. The first one is musharaka. Musharaka. This is like joint venture or partnership arrangement. Musharaka. Joint venture or partnership arrangement. What is this about? All partners, that is the client and the bank or the financial institution or the intermediary firm, contribute capital and are entitled to participate in management. Profits are shared according to a pre-agreed ratio, but losses are shared strictly based on capital contribution ratio. That is the concept of musharaka, joint venture or partnership arrangement. So what does that mean here? It means that, again, a real estate company can partner with a finance house, and they do this all the time, right? So that the house that they are building becomes a joint venture arrangement. And so maybe the real estate company is providing the land, the expertise, and everything to build. Then the bank is going to provide the money needed to build the houses. When they are done and they sell, profits that is made will be shared between the real estate company and the bank at an agreed profit sharing ratio. Se kabafia, meaning where there are losses, they will be sharing it based on the capital amounts that everyone contributed. That is the concept of musharaka, joint venture partnership arrangement. Again, you realize that here you are seeing that pure Islamic finance idea coming in, because the bank is bearing a risk if the thing goes down. That is why they will participate in the management, because they have a huge skin in the game. So if their money is flush down the borehole, they are in trouble. So they will be involved in decision making, in management, and various issues to ensure that they get returns when the houses are sold. And if there is a loss also, they're going to be bearing some of those losses at the end of the day. Number 2, mudaraba. That's like trustee finance. Now, there's a partnership between two parties. Rabul Mal, that is the capital provider, and then the mudarib, that is the entrepreneur. So the mudarib contributes expertise and labor, while the Rabul Mal contributes the capital. So what happens is that profits are shared based on a pre-agreed ratio, but financial losses are entirely borne by the investor. So I need you to understand what's going on here. In musharaka, it's like partnership. So I can bring expertise, some money. The bank can also bring some expertise and money. That is why under musharaka, we said the finance provider, the bank, will be involved in the management. But under mudaraba, Yes, the investor brings the money. The entrepreneur or the client, the business, the client is bringing in expertise and labor. If we make profits, we share in an agreed sorry. So let me take that again. I don't know what happened. So in Mudaraba, the investor brings the money, the clients bring expertise and labor to undertake a project, to undertake a business. If we make profit, we're going to share it in the profit or loss sharing ratio. But if there is a loss from the project, that will be borne entirely by the provider of finance. Because the provider of finance, in this case, the Rabumal, is the one who brought the money. It is our share. That is the idea about Mudaraba. So, a simple example, I said Mudaraba. Yes, Mudaraba there. So let's give an example here in respect of Musharaka for business finance. So let's say a client needs $100,000 to start a business. The client will contribute, say, $20,000, and the Islamic bank will contribute 80%. They agreed on a 50-50 profit sharing ratio. If the business makes profit of 10,000, Obia benya 5,000. If the business makes a loss of 10,000, the loss will be shared in their profit or loss sharing ratio, as we mentioned. So these are what we refer to as equity-based instruments. So in Musharaka and Mudaraba, you realize that the investor is having a direct control, ownership, management in what we are using the money for. Unlike the trade-based where we are just dealing with assets, in equity-based, Musharaka and Mudaraba, the investor has a skin in the game. That is the idea about the second category. But these are not the only financial instruments we have when it comes to Islamic finance. So let's look at a widely used one, especially by government, and that is the sukuk, or what is called Islamic bonds. Now, the sukuk are Islamic financial certificates, often linked to conventional bonds, but they represent an undivided share in the ownership of a tangible asset, not merely a debt obligation. So, get it well here. Get it well here. Sukuk is like an Islamic bond. It's a loan that you are taking. But then what is going to be happening is that here, there is a share of ownership in the assets that is used to undertake the project. So this is what the structure looks like. When you buy a sukuk, you become a co-owner of the underlying assets and receive a share of the profit or rent generated from that asset. And this is what I was mentioning about Nigeria using to finance the infrastructure. So for instance, Ghana need road. So maybe we need a rail line, okay, a railway line from Accra to Kumasi. Okay, from Accra to Kumasi. Okay. And that project will cost maybe 10 million or whatever. Let's say $300 million. Instead of the government of Ghana going to borrow $300 million on the market and have to pay a significant amount of interest on the $300 million, or instead of the government bringing a private person to come and provide this money like that, and they will charge interest on it, government can issue what is called a sukuk bond. What it means is that government will issue a 300 million bond, and everyone who buys the bond is in a way having an interest in the real business that has been established, or the real line that is going to be constructed. After it is done and they start running the Accra-Kumasi rail line, whatever profit that is coming in from that project will now be shared to all of the people who bought the bond. That is the idea about sukuk. So you realize that here, government is not paying any interest to anybody for providing loan or for lending government money. You invested your money and it is tied into the railway business from Accra to Kumasi. So when the business makes any money, that will be shared between the people who bought the bond. These are the ideas we must understand when we talk about the financial instruments used in Islamic finance or under the Sharia law. Now, I am expecting, as I mentioned earlier, that yes, although we have all of these tools available, I'm expecting, and probably that's what is going to be happening, that the government is going to be executing probably sukuk. Okay, I think it's something that is indirectly being used, right? Indirectly being used because, for instance, if you look at the financing that they use for the Terminal 3 expansion project under Mahama 1.0, the loan that they took to finance the Terminal 3 project, the money from the operation of the Terminal 3 is what is being used directly to repay the loan, right? Plus interest. So it's not like that is becoming a burden to the government. So in a way, we are seeing sukuk bond being there, but it's not really sukuk. So now if the Bank of Ghana finishes its framework and this is introduced from next year, we may see the government issuing some of these sukuk bonds through the central bank to the market. And that may be used as part of financing some of the big push projects and some of the other infrastructure projects that the government is seeking to undertake. So I am really expecting that sukuk is going to be one of the bonds that will be used, whether I like it or not. In addition to that, as I said, to help farmers, the Salem instrument, I think, will be one of the things that will also be used if we go with education well. Because one of the problems in this country is that there are various things available, but there are less information available about them. Right? So if education goes down well and banks are ready, financial intermediaries are ready, then we may see maybe Salem also coming in, so that many of these farmers who cry foul, who always have to worry about, hey, my goods are destroyed, I don't have a sellout, we would deal with that, which means that the farmers are going to be protected. They wouldn't have to worry again about anything. And the finance house would then arrange with the final customers who will buy the produce when it is harvested, and everybody will be relieved, and we can develop the economy well. So I think Salem, in my opinion, could be one of the things that will be coming in. Then certainly Ijara and Murabaha will also be coming in at the end of the day. But these are the instruments available in Islamic finance. So what's your take? Would you say that let's go for Islamic finance? It's not like let's go. If you're a business owner and this thing is introduced and you can explore it, I think it will be the best way. It will be the best way that many businesses will get financing. right? Because there will not be anything like collateral, right? Even if there is, there will not be anything like collateral, because the bank is giving you an asset. Like, for instance, what we spoke about, the Murabaha. You want a delivery van. Currently, you have to go borrow the money from the bank, and the bank will charge you interest on it, and the bank will need collateral facility and all those things. Under Murabaha, the bank is buying the delivery van for you, and they are selling it to you to make profit on it. So technically, the bank can still take a claim on that van if you are not able to pay. And they have a skin in the game. They can monitor you because it's tied into that asset. So businesses are going to be drawing more to the Islamic finance, in my opinion, if it is executed well. If it is executed well. So we've looked at the core principles underlining the Sharia law, doing business under the Sharia law, Islamic finance. We've looked at the differences between the Islamic finance and then the conventional financing options available. Number 3, we've also considered the issues in respect of the various types of Islamic finance tools available, right? Instruments available that the government can, or that the central bank can explore in. But let's come to the final part of our discussion, and that is going to be the issue in respect of the accounting standards. How do we account for this in the financial statement? How do we account for this? Now, I have a brief information here, okay, about the history, okay, the global landscape of Islamic finance. And I spoke about this briefly. So we're going to be sharing this document with you. After the stream, it is going to be available under this video for download on YouTube, on our YouTube page. So it's going to be available under this video for download. And you may go through the history if you are interested. But as I said, this thing started in the Middle East, okay? Because, you know, Saudi Arabia, United Arab Emirates, Bahrain, Kuwait, Qatar in the 70s, right? The 1970s. Then Iran came in the picture around the 1983. Malaysia also came in 1983. Indonesia came in 1990. Okay, Turkey, now called Turkey, in the 1980s as well, to use some of them. Then in the 2000s, UK, Luxembourg, South Africa, Hong Kong, and Nigeria also around the 2000s came in that particular case. And so in these countries, most of the tools they use include Murabaha, okay, Ijara, Sukuk, all right, and then Mudaraba, and then Musharaka. Do you get the idea? So you realize that almost all of them are being used, but predominantly we see the Sukuk, especially by state institutions or government, Murabaha because it's good, Ijara also good at the end of the day in that particular case. But predominantly for us in Ghana here, the Salem could also work well, as we explained earlier, because of the fact that we are predominantly having a lot of people growing crops, doing businesses, and they would want to have people buying those things at the end of the contract. But that's just a brief history, okay? Just the global landscape. Let's come to the accounting standard. So far, the discussions we've had, you must have this understanding as an accountant. That's the impulse here. You must have this understanding as an accountant. Why? As we mentioned, if you are going to be writing financial management, these instruments, you're going to see them, and it is going to be written. That examiner may ask you about the various types of financial instrument. The examiner may ask you about it for a 5 or 6 marks question. In strategic case study, the examiner could also ask us about that. But then, as I mentioned, where we are going into, we need to also understand how these will be represented in the financial statement. Because if banks are going to move from, or some of their transactions will now be not giving money for interest, but they have to engage or use Islamic finance, how do the banks, or how would the bank recognize this in their financial statement? On the other hand, if I'm a business and I haven't entered into any contract involving Islamic financial instrument, how do I present that also in my financial statement? Because the bank didn't give me money, we entered into a transaction. So how do we account for this? And this is where financial reporting and corporate reporting comes in, that we must understand. So for the purpose of IFRSs, the way we're going to account for the Islamic financial instrument will be based on the concept of substance over form. Right? So we're not going to be looking at the legal form of the contract, but we're going to be looking at the substance of the contract. And that is going to drive how we will present these in the financial statement. So we will be applying the substance over form concept in accounting for these in the financial statement. So let's give some ideas here. I will not go much deeper because we're going to be doing the workflows about this later, because we want to look at some of the framework when the Bank of Ghana is done with the framework, and look at some of the instruments that they are going to be bringing. Then with some guidelines again, because the Institute of Chartered Accountants Ghana is going to be bringing out some guidelines on this as well, because they are involved in all of these things. So we're going to be looking at much detail workflow things later, but I want us to understand some fundamental basic issues, excluding calculations related issues today. So first, let's look at the first one, Murabaha, the cost plus pricing, where we said, okay, an entity is looking for a delivery van. The bank can buy that delivery van and sell it to the clients at a markup, right? At a profit. So in the books of the lender, which is a financial institution, they will recognize a financial asset, just like a loan in accordance with IFRS 9. Because they didn't buy the assets to use in their business. If they bought the assets to use, then they will apply IAS 16 property, plant, and equipment, isn't it? But they are buying the asset and subletting it, or subselling it. And so in the books of the bank, they're going to be recognizing financial assets in accordance with IFRS 9. So initial measurement, we are going to be recognizing, the bank is going to be recognizing a Murabaha receivables, which is a financial asset equal to the cost plus the margin. So if they bought the vehicle for 200,000 Ghana cedis and they put a markup of 30% on it, that means that the amount of money or amounts now given to the person is going to be 260,000 Ghana cedi. That will be debited into their Murabaha receivables. Then on subsequent measurement, it will be measured at amortized cost. Usually, it will be measured at amortized cost because it's a financial asset, but it is like a loan given to them at the end of the day. So it will be measured at amortized cost so that the profit component, which is going to be based on the effective rate, okay, on the deal, will be recognized as an income over the contract at the end of the day. So that is the first thing we must understand. So income recognition, the profit is recognized over the installment period using the effective profit rate method, or what is called the effective interest rate. That is the idea about what will happen in the lender's books. Now, so you got to understand what's happening here. As we mentioned, the entity bought an asset and then sold it at a profit. So more or less like they are going to be doing trading, quote unquote. And so at the date of the transaction, They've sold the asset. So the value of that sales will be recognized as revenue. Then that interest component is what is going to be recognized as income over, not interest, the profit component, okay? Because we don't have to use interest here. That profit component is going to be recognized over the contract. Now, in the books of the business, they are going to be recognizing financial liability, just like a loan. Yeah, because I now have the delivery van that I'm using for my business, but it is not mine, right? The bank bought it and sold it to me. So more or less like a loan generally. So what will be the double entry? Yes, I'm using the asset for the day-to-day running of my business. So we debit PPE. Then we're going to credit Murabaha payable, which is the same as financial liability. I hope you are getting the idea. So really, the accounting for the financial instrument, yes, the Islamic financial instrument will not be far from accounting for the loan. Only that context must be made. So let me take that again. If we need a delivery van, conventionally, the bank would have given us the money, the loan, charge us interest, and we'll use the loan to go and buy the asset. Right? And so the first thing is that the bank has given us the money. So we'll debit our cash book and then credits the loan or financial liability. Then we're going to be charging interest on the loan, and that interest on the loan will be charged into the P&L account. And that's it. Then when we eventually go and buy the asset, you credit cash, debit PPE in that regard. But under Murabaha, what is happening is that we are not getting the money. We are getting the asset. So we debit our PPE account with the price at which the financial institution is giving us the asset. Then that same amount will be credited to the financial liability. So on subsequent measurement, we will depreciate the asset because we are using it for the day-to-day running. So if we are using it for the day-to-day running of our organization, then we will depreciate the asset in accordance with IAS 16. If it is an inventory, we'll apply IAS 2. If it's an investment property, we'll apply IAS 40. So on subsequent measurement, the asset will be accounted for in our books as per the applicable standard based on the purpose for which the asset is being used or is serving. Then on the credit side, we are recognizing the Murabaha payable, which is the financial liability. And that is also going to be carried at what? Amortized cost. So that any difference, which is the financing expenses between the original cost and the price at which the bank sold to us, is going to be recognized as interest over the life of the contract. So technically, you will say, oh, there is not much difference between the conventional loan accounting and then the Murabaha or financial instrument accounting. But there is a key distinction that you have to be mindful of in the accounting treatment, as I've explained here. Number 2, Ijara or Ijara. That is the leasing idea here. So what are we saying here? Ijara is a contract to transfer the rights to use an asset for a specified period for a rental payment. And so since it is leases, we're going to be applying IFRS 16. So Murabaha, we apply IFRS 9. Ijara, it is effectively leases. So we apply IFRS 16 leases. Okay. So what does that mean? It means that the finance house leasing the asset to us is the lessor. So they will apply lessor accounting. Then we, the entity lessee, will apply lessee accounting. So in the books of the lender, who is the lessor, remember, under IFRS 16, the lessor must classify the lease whether as an operating lease or a finance lease under IFRS 16. So the lender or the lessor is going to be classifying the lease as to whether it's an operating lease or a finance lease. Technically, here it's about the substantial transfer of risks and rewards. So the same issues about classification of the lease in accordance with the lessor is going to be applying here. So the lessor can either recognize it as an operating lease if there will be transfer of risks and ownership in the asset. If there will be no transfer, then it will be an operating lease. But if there will be transfer of risks and ownership in the asset, then the lessor will recognize it as a finance lease. Now, if it is just an operating lease from the perspective of the lessor and the nature of the contract, then it's simple. The lessor retains the asset on its statement of financial position. They will depreciate the assets. Then the rental income is what will be recognized as revenue on a straight line basis. You get the idea? So, because it is an operating lease. So, since it's an operating lease, they will still carry the asset in their books. And then they may depreciate the asset. Now, it depends again, because under certain circumstances, that may be accounted for in accordance with IAS 40 investment property. So, whatever accounting standard that they are applying may be applicable. Remember, although by default, investment property are carried at fair value so that any fair value gain or loss will be recognized in the P&L, there are circumstances under which, for instance, if the asset is going to be used and there will be reduction in the value of the asset, then it will be prudent to depreciate the asset. So the lessor will still carry the asset in their books under an operating lease and depreciate the asset. Then the rental income will be recognized as revenue on a straight line basis in the profit or loss account. If the nature of the contract states that the lease is a finance lease because there is going to be transfer of risks and reward, then what is going to be happening is that the lessor must derecognize the assets in his book or in their books. So in that case, they will recognize lease receivables. And then the rental payment will be split between the principal reduction and then the profit component. That is applying the amortized cost principle, just like the normal lessor accounting when it is a finance lease. So that is the idea here. That's the idea here. Again, if you pay attention closely, it looks like it's the same thing, just with a thin line for the accounting issue that you must understand. How about the lessee's books? Remember, under IFRS 16, the lessee doesn't classify the lease. So, but the lessee has two options to account for the lease from IFRS 16 perspective. The lessee can adopt the low value approach. The low value approach is where the lessee says that, hey, listen, yes, although we have leased the asset, we will account for this asset as a low value asset. So we don't even want to recognize it in our books at all. We'll just treat it as a normal rentals so that every year when we pay the rent, we'll just be expensing it in the P&L account. So in that case, the journal entry will be we debit profit or loss account when we pay the lease, and then we credit cash. If at the reporting date the lease has not been actually paid, then what is going to be happening is that we will credit payables on the statement of financial position. But if the lessee will apply the full default lessee accounting in accordance with IFRS 16, then initial recognition will be we recognize the right of use of asset and then lease liability. And you know lease liability here is going to be equal to the present value of the future lease payment. On subsequent measurements, since we recognize the asset, the lessee will now charge depreciation on the asset, and then the effective interest on the asset is going to be recognized in the financial statement. So just like how we do normal lessee accounting, that's the same idea that is going to be happening here, so that the effective interest is what is going to be charged into the P&L account. That is the second idea, Nhyira leasing. So Murabaha IFRS 9. The financial institution will recognize financial assets because they are the ones giving the money. Then the client, the business, will recognize financial liability, IFRS 9. In Nhyira, it is a lease arrangement, so we apply IFRS 16. The finance provider, the lender, is the lessor. Then the business entity who is now using the assets is the lessee. So IFRS 16 will be applicable here. Then we come back to the third one, musharaka or joint venture arrangement. Musharaka or joint venture arrangement. As we mentioned, this is a partnership deal where the financial institution and the business jointly contribute capital and share profit or loss based on a pre-agreed ratio. So what accounting standard will be applicable here? If you're a good student in the financial reporting class or the corporate reporting class, you will know that joint venture arrangements or partnership arrangement will be accounted for either in accordance with IFRS 11 or IAS 28, or it depends again, IFRS 9 may come here. Because if we undertake a joint venture arrangement, then IFRS 11 may come into town. If we are seeing that as an investment in associate, then IAS 28 may come into town. If we are seeing it as more of equity control, then IFRS 9 may come to town. So in the books of the lender, that is a financial institution, what do? Depending on the nature of the arrangement, they may apply joint venture arrangement IFRS 11, investment in associate IAS 28, or IFRS 9. So let's look at the accounting treatment. If it is a joint venture arrangement, then we use the equity accounting to account for the investment, recognizing a share of the partnership profit or loss. Because in accordance with IAS 28, joint venture arrangement, investment in associate, we do equity accounting. So we bring in the cost of our investment in the entity, and then share of profit or loss that is going to be recognized in the financial statement. That's what we need to understand there. If it is an investment with no significant influence, then IFRS 9 is going to be applied, equity investment, so that it will be carried at fair value through P&L at the end of the day, because it will be seen as what? Equity investment there. That is what the lender does. In the books of the business, there will be a separate entity, and so we are going to be accounting for the business. That is a joint venture arrangement that has been undertaken, right? We'll be accounting for it because if it's a joint venture, we'll be accounting for it separately so that we'll account for the assets, account for the liability, get the profit or loss for that particular arrangement in that case for that. So the assets, liabilities, revenue, expenses, and everything will be recognized in accordance with IFRS. Then at the end of the day, the net profit or loss is determined and allocated to the partner's equity account based on the musharaka agreement. So this is the idea about what happens in musharaka. So it depends on the nature of the contract and the accounting standard that we will apply in the books of the finance house. And that is very important. So we may apply IFRS 11 or IAS 28 or IFRS 9, depending on the nature of the contract in question. Then let's look at sukuk. As we said, this is Islamic certificates. It's like a bond, normal bond in that case. But unlike bond where you pay interest, sukuk, you don't pay interest. You get your profits from the project or assets that your investment was used to acquire. So sukuk are classified based on the nature of the underlying structure. Because the sukuk can be an ijara, it could be a murabaha, or it could be mudaraba. Because in sukuk, we issued a bond. And we got the money. The money is going to be invested in an asset or used to build, construct, or acquire an asset. That asset we acquire could be leased out, Nhyira, or Murabaha, sold at a markup to someone else. So the way we do the accounting will depend on the underlying structure. What is it generally? So issuer, which is the business. Liability, just like Sukuk, or equity, if it is going to lead into some equity instruments coming in, just like convertible loan note, IAS 32 may come up. So Nhyira Sukuk is a liability, so we recognize a financial liability so that periodic payments or rent are recognized as financing expenses. But if it's a Mudaraba Sukuk, which is an equity item, then we recognize the proceeds in an equity class temporarily so that the profit distribution is treated as an appropriation of profit, not an expense. So this is the idea about what is happening. So let's say that we issue a bond. So the entity issued a bond and they raised $100,000. Then they used that $100,000 to buy a car for a company. So a business needs money. Oh, sorry, a business needs a delivery van. Let's go back to our delivery van example. The bank doesn't have money to give to them. So the bank will issue a Sukuk certificate so that people will subscribe to it. Then, so it's like a special vehicle instrument. So that special vehicle instrument, Sukuk, the money will now be used to buy the delivery van. Then it will be sold to the business at a markup, as we discussed, so that the profit that is going to be coming will now be shared among the parties who subscribe to the Sukuk bond. That's what is happening here. So that is why we are saying that in the Murabaha Sukuk, like you have an equity in the asset, the proceeds comes in as an equity just temporarily, and at the end of the day, everybody gets their initial capital, and then the profit will also be allocated at the end of the day. In the holder's book, so this is the issuer's book, the banks, what they are going to be doing, the intermediary firm, what they are going to be doing. So the holder, which are the investors, you, the person who will buy the Sukuk certificate. So the bank is issuing, or the government is putting together that special purpose vehicle. Then our company goes to buy one of those bonds. So instead of us buying traditional how do we call it? Government bonds, treasury bill, and those things, or, you know, lending the money out or doing fixed deposits, we go and buy one of these certificates in the special vehicle. How do we account for that? That's a financial asset in accordance with IFRS 9, isn't it? Because if you buy a bond instrument, that's a financial asset in accordance with IFRS 9. And so it's a debt-like, if it's a debt-like Sukuk, then certainly we apply the amortized cost schedule, or maybe carried at fair value if we can test the fair value recognition well. If it is an equity-like, then certainly it will be carried at fair value through profit or loss at the end of the day. So that is also how the holder of the Sukuk certificate, or the lenders or the investors, will see this. So again, if you pay attention closely, there is some resemblance with a thin line of distinction between the traditional accounting treatment and the treatment under Islamic finance. Are you getting it? So the goal here will be for us to be able to really identify those extra treatment, those specific issues under the financial instrument idea in that particular case. Let's see, what else do I have? Okay, yeah. So these are the the things that I can share with you in respect of these bonds, really. So we've looked at the issue in respect of the first one, which was Murabaha, and we've looked at Ijara, we've looked at Musharaka, and then Sukuk. Basically, as I said, these are the 4 key issues that will have traditional accounting relationship that we need to be mindful of. And these are the things you must understand when we talk about Islamic finance. So again, as an accountant, this thing that the Bank of Ghana is bringing up, you must know about it already in your financial management examination, in your strategic case study examination. But in addition to that, you must have an understanding from the financial statement preparation perspective in financial reporting FR, and then corporate reporting CR in level 3. And these are the things that we must understand basically about this. In the next episode on this particular topic, we're going to be taking some practical illustrations or examples where you're going to see specifically how these will be accounted for, right? So for instance, if we undertake a sukuk, we'll take a practical example, and then you will see in the books of the issuer, the finance house, how it will be accounted for, and then in the books of the business who buys the bond, how it will also be accounted for in that particular case. And these are the things you must understand when it comes to dealing with financial instruments. Thanks for watching, and I'll catch you in the next one.